Hey everybody, welcome to our conference call. This is our investors conference call. We usually have one, I don't know, every couple weeks, 3 weeks, once a month. And when we have them, we record them so that they're archived. They, of course, are archived at the website, investingtherightway.com, where you can watch back stories of this. And we usually discuss trades. And in this case, we hope there will be a learning experience involved in it today. I'm joined with my co-host, Mr. Tanner. You can't see his shining face on the screen, but he is there. Hello, Mr. Tanner.
Hello, how you doing, Mr. Jimmy?
Today we're going to talk about a few things, quite a few things. I have a laundry list in front of me that I want to talk about. The first thing I want to talk about is me admitting I don't know. Now, if you're not subscribed to the newsletter, I encourage you to do so. You can do so through the website, investingtherightway.com. There's a place right on the front page for you to sign up for the newsletter. It's completely free. We typically send one out just about every morning, not completely 100% every morning, but at least 4 days a week, you're probably going to get a newsletter. It'll outline you about what happened the previous day, what we expect to happen that day, and I don't know, some general occurrences that have happened in the market to be wary of or to note. And last week, I issued a newsletter that basically said, I don't know what the market's going to do. I just have no idea. And in doing so, I guess I'm so used to talking to people that actually know me, they would expect for me to tell you I don't know when I don't know. But it sent up a red flag with a few people, including Tanner. And Tanner kind of counseled me and said, maybe we need to rephrase that, especially for the new people coming on that don't know you. Instead of saying, I don't know, for somebody that doesn't know you, that can come across as, well, why do I want to listen to you if you don't want to know? And instead, maybe use language of, the market is rather indecisive, which is basically code for I don't know, but at least it sounds better. And so for the people that are coming on in the future, that's what they will hear. For you people that already know me, expect a change in language, and that's why, because I don't want to look like I'm a complete idiot. I have to be a bit more politically correct. Would you say, Tanner?
Yeah, it just sounds better. And the fact is, Jimmy, is a tremendous amount about what's going on, and I know that, and the people who've been following you for a while know that. And so whenever you don't know, just having a title will make it sound a whole lot better. So I agree.
Expect a language change in the future. But if you followed the newsletter, I did come back the next day and fuss at my own self, thanks to Tanner and a couple other people. One of them was Pastor Carl actually gets the letter, and he fussed at me. He says, maybe you should probably think about changing the way you say that. So that's the first thing that I wanted to address. I do want to reiterate that if you're not subscribed to the newsletter, you're crazy. You should probably do so. When we make a prediction on what the market's going to do, we're about 85% accurate, would you say?
Yeah, really close to that.
Yeah. So that will certainly help on plays that are affected by the market, plays like SPY, things that are heavily weighted in the S&P 500, like Facebook, for example, is heavily weighted in the S&P 500. And so if you're in a play that's market-driven, like a Facebook, then you probably want to get a good sense of what's going to happen before you jump into a play. That may alter your decision. Speaking of Facebook, we got into a Facebook play today, and I've got it pulled up on my screen. You should be able to see my screen, but if you're also subscribed or signed up through some sort of tracking program, we of course recommend TC2000. That's what I have pulled up on the screen. Go ahead and pull up Facebook. You pull up the daily chart. We want to look at it real quick. And one of the things that you'll notice is on the screen here, I've got the 10-day and the 20-day moving average. And you will see that Facebook has become what Tanner and I have lovingly referred to as a 20-day mover. It tends to follow its 10 and 20-day moving average. When it hits its 20-day moving average, it always seems to bounce up off of it. We played it on this day right here. You can see that we've got this spinning top doji that was formed on that candle. Let me zoom in a little bit. And what I did was I waited until it actually opened here. Okay, it fell. I waited for it to breathe down, and when it hit its 10-day, because it had been very recently on its 20 the previous day, that's when we bought. It moved up. I felt like it hit resistance at this level. We got a pretty good double off of that, sold at that point, and then it retracted a little bit for the rest of the day and formed that spinning top doji. But what's interesting to point out on these 20-day movers is whenever we hit our 10-day, that's a really good time to buy. Correct, Tanner? I'm going to let you jump in and talk about how to play Facebook and similar stocks.
Yeah, whenever it hits the 10-day, you can see how over time it hits the 10-day and typically bounces up off of it. And it may do it for 1 or 2 days, like back on the 5th. You got 2 days worth of upward movement there. You see, even when it came down and tested the line on the 9th, it tested the line all the way down to the 10-day and then moved up off of it. It opened on the 10-day on the next day and then moved up for a nice gain. The next day, it did not open on the 10-day, but look at what the gain did. So even if you were to play it as a day trade, you could play it as a day trade for, well, I mean, let's count them from the 2nd on. It never went below the 10-day moving average, but it kept on making new highs. So for new people or people without day trade approval, I wouldn't recommend doing it every day, of course, because that'll get you into trouble with your brokerage account. But you could have picked 1, 2, 3 days out of this 1 week and made a sizable gain off of Facebook.
And they tend to be what we call priced in pennies, meaning the bid and the ask is with just a few cents between each other, which means you could just go in with a market order. You don't have to try to put a limit order and get in the middle somewhere and wait to see if it's approved. You could just jump in a market order because it's less than 5-cent spread between the bid and the ask.
Yep. And that is great because then even if it moves against you, to get out you could use a market order as well. And the reason why market orders work on like a Facebook is because you can take a look at the volume on the number of contracts being traded, and it's tremendous. So I like to call Facebook and other stocks that are similar to it momentum stocks. It just means that everybody and their dog out there is playing them. So getting in and out of them doesn't require any real experience with using limit orders. So especially for new people or people who just don't want to have to mess with sitting and waiting and doing a limit order to try to get into something, Facebook is a great stock to do that with.
Okay.
It's inexpensive as well. So as that's one of the pluses, especially if you're doing a weekly option off of it. So
now I want to talk about something. This will be an introduction to it, and we'll follow it up later when we discuss GDX. But I want to discuss something that we refer to, the market refers to as cost averaging down. So we'll use Facebook as an example. Let's pretend that Facebook opened on its 10-day moving average. All right. And you're like, great, that's a good buy point. And you buy in. And it indeed moves up for a couple of pennies, but then reverts itself and moves all the way back down to the 20. You can do what we call cost averaging down. So okay, fine, it's on the 20. I'll buy again. Now that same strike price is much cheaper because it's moved against me. So maybe I bought one for 30 cents. And it moved down to its 20. The 20 is not too far away. And now that 30-cent option is worth a nickel. I'm going to buy some more. And so we take the average between what we paid for at 30 cents and what is now valued at 5 cents. We buy it again. And now we've averaged our costs down once you've averaged those back in. And we do that because, again, the 20-day has proven on Facebook to be a very stable line of support for it. Okay. Now, what happens if you bought it, okay, and it turns around and does like on the 15th and the 16th here, moves down to its 50-day moving average? Would you cost average down again, Tanner?
Yes, I've done it multiple times with other things. It all depends on what expiration you're buying, of course, and what day of the week it is.
Sure.
If you let's say that you bought right here, and it was something that you looked at, and you held it through this, and then you held it through the next day. And I'm sorry, I'm looking on my screen using my cursor. Let's say you bought it on the 11th.
Thank you.
Yes, sorry. So let's say you bought it on the 11th, and you expected it to continue to move up 1 or 2 days, and then the next day it moved down. Well, obviously you wouldn't cost average down on this Friday here. Let's say that on Monday, on the 15th, you bought it when it hit its 10. You
Right.
bought the expiration for Friday, okay? And you bought it on its 10, and instead of bouncing back up, it decided to move down to its 20. You could have bought more that were going to expire on Friday, and then it moved even further down. So you could have kept on buying that same strike price with 4 more days worth of movement, and the only way that you would have lost everything is if Facebook continued to move down beyond the 50 days for the rest of the week and never moved back up. But in this illustration, if you would have cost average down, you could have cut your entire cost down to probably pennies on average for each one of the contracts. And by Friday, look at how your pennies would have become dollars.
Yeah.
It moved from 73 all the way up to, by Friday, it moved up to 77.91 to close, and you wouldn't have kept it through the expiration. So you would have sold out, and what would have cost you 30 cents on the 10-day, cost you nickels on the 20-day, cost you pennies on the 50-day when it bounced up. Now you've cost average down, and you've made a sizable profit with very little risk, because obviously if you spent 30 cents for the first one, here's kind of my rule of thumb. If I'm going to, I figure out what I'm going to risk before I start a play, and then I put that much risk in it. If it moves against me, I will put maybe 2 or 3 more contracts with it, because now I'm paying nickels for what was 30 cents. So another $15. If it's down to pennies, I'm going to buy 5 or 10 of them. Why? Because the most I want to risk is somewhere around $60 on this particular type of trade. And if it goes against me, I lost $60. However, if you do the math, your $60 that you risk, if it would have played out like this did, would have become hundreds of dollars, because for what you paid pennies for, it's now worth dollars.
Okay.
Does that make sense, Jimmy?
That absolutely
Explain that
makes sense
good?
to me.
Okay.
What I want to do is, and Greg's saying yes, but not on Friday. That's exactly right. It's very dependent on how close you are to expiration. So you obviously don't want to do this on the last day. I'm going to unmute everybody. And now I want to ask specifically about this question about cost averaging down, or about Facebook in general and 20-day movers. Does anybody have any comment or questions? Comments or questions?
I like the average down. Awesome.
Okay, this is Greg speaking, correct?
Yeah.
Have you done that yourself?
Yes.
Okay.
Yep,
Has it
I've
saved your
battled-
bacon a few times?
It has saved me, but it also destroyed me on a Friday too. So.
Yeah, you don't want to do it on a Friday.
Oh yeah, experience.
Unless
definitely
your
getting
expiration date is the
Next week.
following Friday.
Correct.
Yeah.
Could it work on a Friday? Sure, but it didn't work for me. And I did my average, I think, 3 times that Friday, and finally I just sold. I said, forget it. I'm not fighting it no more. But during the week of that week where I lost, I battled from underwater and became profit twice by buying back in. So I like it.
Especially if you're following those moving day average lines or good support or trend lines. Go ahead, Tanner.
I was going to say, using the Facebook example, even on the next day, like the 16th, let's say you did cost average down, you don't have to make it back even above your original purchase price to make your money back.
Yeah,
Correct.
because you've averaged that cost down.
That's exactly right. So now you could have actually turned a profit on the very next day, and it's still out of the money, and it's still, your original cost wasn't met. But because you averaged down, you were able to make a profit, or at the very least, make back what you had lost from your original trade by that next day. Now, will it always happen? No. Like Greg said, it doesn't always happen, but you increase the possibility of being right by doing it.
And one thing I want to point out, especially with a Facebook, you have to look at your strike prices, and we like to buy out of the money so that they move into the money. It gives us the best opportunity for the maximum amount of gains. You have to look as you're choosing that strike price and tell yourself, can I get to that next strike price? Because if you're at on the 5th, for example, and you're at 76.09, and the next strike price is $77. It's not, but we're just using this as an example. On your particular stock, if it's at $77, you have to ask yourself, can I get to that next strike price? And if you don't think that the average daily movement is going to bring you up to and cross that strike price, then you kind of want to move on or wait. Any comments on that,
Yep.
Tanner?
Yep, and you want to use your average true range to help you determine that.
Yes, and we've covered that in a previous class video on the class page.
Absolutely.
So we're not going to give you a description of that. Just go watch that video if you haven't seen it. I'm going to go ahead and mute everybody and then unmute Tanner. There we go. All right, so we're going to move on. The next thing I want to talk about is TLT. So I'm going to pull that up. There we go. So let me back out a bit. TLT tends to have this nice, repeatable, predictable up and down pattern that we like a lot. But we like to buy it at the extremes. Now, we've discussed Bollinger Bands, and if you've watched that video, then you recognize it on my screen. I like Bollinger Bands. That's this hazy, light, opaque area in the middle, this milky band that runs through it. And by buying it at the extremes, what I'm talking about is particularly on the high end of the extremes, when it reaches that top end, that's when we're considering buying. And if we're following we use our trend lines as well. So the day that we considered buying TLT was on the 27th. However, Tanner and I have learned that when it's at the extreme and ends at the extremes, it tends to gap up the next day for no apparent reason and then fall. And we wait for that gap to happen before it fell. And that's exactly what did happen. So on the 27th, we waited. On the 28th, it gapped up. And once it gapped up, that's when we bought. Okay, and we wait for it to pull back in that regard. We cashed out on the very next day, or I did. I'm not sure if Tanner made this play or not. If I would have waited, you can see it gap down tremendously on day 2, and I would have made a whole lot of money then. But once I'm in the profit-taking territory, I tend to just go ahead and take it. I'm not greedy. Some would say, well, if you'd have been patient. No, patient has burned me many, many times. If I'm in the profit-taking area, I just go ahead and take profits and don't look back. I don't kick myself over that. Another example is here. We had consolidated on the bottom and actually pushed our Bollinger Bands down for 3-4 days in a row. I saw that it was giving me this doji signal on Thursday. Was it Thursday? Yes, Thursday the 18th. It gave me an almost perfect doji. And so towards the end of the day, I bought, figuring that it was going to move up. It did gap up, and I actually sold. Once it gapped up, it moved and crossed the strike price. I had a nice little gain off of that. I didn't buy Friday's expiration date. I actually bought the next Friday, okay, which gave me some time then if it didn't move up. I bought at the gap up. which looked to be a very sound decision because it fell shortly after that. I'm like, ha, 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 I picked the right time. And then towards the end of the day, it rallied back, pushed to new highs of 1460. And if I'd have waited till it got to the $14 or $14.50 strike price, I would have made a very nice return, maybe a triple, probably a triple, maybe a quadruple. So, but I'm not kicking myself over that. I consider playing it again, but we've got some lines of resistance, and I'm not sure if TLT is rolling over and turning into a downtrending stock. So, Tanner, you want to jump in and weigh in on TLT, on how to play that and what we think's going on over the last set of candle formations on the daily chart?
Sure. I actually want to go back to the other example that the first time we bought into it, over here where it gapped up, let's see here, at the end of August. Let's say that we did buy it early before it gapped. So we bought it early on the previous day, and it gapped up. Well, again, we didn't buy that week's expiration. We bought a week out because we wanted to make sure that we had time to be wrong. So let's say that it did gap against us and expanded those Bollinger Bands like it did. On that day, again, we would have cost averaged down. Cost averaged down on that day, and the next day it actually opened where it closed and then moved against us more. We could have bought again right there for the next week's expiration, because this is a Friday that you're pointing at right now. Look at what it did on Monday. And actually, Jimmy, I was in that play, and I did hold it through Monday. And I sold upon the gap. I didn't wait for it to move all the way down because I didn't. Again, you don't know whether it's going to go any further down. But the gain that I got on that day was a real solid double from the first option that I bought. So let's talk about where this week, the doji, perfect play off of the doji. The fact that it gapped up meant that it was going to move up higher. Anytime you see a gap up after doji at the extreme, it is a change in investor sentiment. So whenever you see a doji at the extremes, like at resistance or at support, what it does the next day gives you a very good indicator of what the intention is, what investor sentiment is indicating. So the fact that you had a gap up off of a doji at support means that more than likely investor sentiment has changed, at least for the time being. And I agree with what you said about the question as to whether TLT is rolling over or not, because now if you remember and have
Let's
taken
back
all
up.
of the
I'm going to interrupt you. Let's back up,
Okay,
because
go ahead.
you kind of changed topics within that, and I want to address that, because what you're saying is, and just be truthful with me, brother, I made a mistake. When I got my doji at support after it had been there for forever, and then it gapped up the next day, I should have just went ahead and held it. Even though it moved against me after the gap, I should have just been patient, because I had an entire next week to wait for.
That's correct. So off of a doji at support or resistance at the extremes, anytime you get a gap outside of the previous day's entire trading range, it is a change in investor sentiment. And the whole reason why is because that means that more people were buying it than were selling it, or it wouldn't have gapped.
Okay. Now go back and address the whole rolling over thing.
Well, TLT is one of those, it is a, goodness, it just escaped me. It's an ETF based off of a 20-year treasury, 20-plus year treasury, and if you've taken a look at what TLT holds, it holds bonds that are, some of them as old as 29 years or even older, to expiration. And with with the market being in the position that it is, the S&P 500 and everything at all-time highs, the idea is that interest rates are going to eventually start to rise. Well, when interest rates rise, TLT falls. So you see that it's possible that it has started to roll over. It has been in an uptrend, and it looks like it could be starting a downtrend. And so now you have to use your moving averages possibly as resistance instead of as support. And so we'll know over the next few days whether that is the case or not. If it breaks through, if the price breaks through the moving averages and starts a new uptrend, then of course we'll have to wait and see what that does and how it plays out. But buying it at the extreme off of a doji move, that's money. A move off of a doji is almost always money.
It's a high success rate at the extreme. A doji at the extreme.
At the extreme, that's right. A doji in the middle, it doesn't have as much meaning. But especially when you have a doji at the extreme, and there's all kinds of dojis. There's hanging man, or hanging man. There's gravestone doji. You can look those up on the internet. But anytime you have a doji, the move, how it opens off of the doji at the extreme, is a very good indicator of investor sentiment.
Now, it's right a lot, but it's not always right, and I will point your attention to the 10th, 9, 10, 14.
That's exactly right.
We're at the extreme. We get a doji. The next day, it gaps up, okay? And you would assume that it would do exactly like it did yesterday. Only in this case, it did. It did gap up. It did move up, but then it reverted and came down hard. So that is an exception to the rule, and it's not 100% right. I don't want you to see a doji and say, I'm in, especially when it gaps up the next day. So it's not 100% right. In this case, because we know that TLT is involved and tied directly to the bond yields, well, I'm looking at the market in general, trying to determine how that's going to affect bond yields to make my determination if it really is at the extreme or not. In this particular case, we had come back through our 20. We had been bouncing off of our 20-day moving average. We had set on our 50. We moved down below the 50 where we formed that doji. And so because there was so much weakness in it at the time, I wasn't in. The market itself was forming new highs during that time frame. So if we look, that is the 10th. Let me go over to GSPC. We'll go to the S&P 500 and we'll look for the 10th. Here, this whole time frame is we're showing some weakness in the S&P too after forming new highs. So if we move off of the support lines on the S&P, that's going to turn around and affect TLT. It should theoretically move in the opposite direction, which means TLT would move down even further. And guess what? It did. Because we got some support on the 20, we began to move up. And what did we do the next day? We moved down on TLT. So you have to take a lot of things into account. Specifically with TLT, you're looking at the other factors that affect it. So just because you see a doji and a gap up the next day on TLT, make sure you know what's going on with the general market. If you're playing Facebook and it provides a doji on its bottom, its extreme, and it gaps up the next day, make sure you know, because it's weighed so heavily in the S&P, make sure you know what the S&P is doing too before you just, I'm all in. So there's additional analysis that we have to play into that aside from Tanner just candlestick formation, correct?
That's right. That's right. Market tone has a lot to do with whether you're going to be successful in any play. So, again, that's available on the website, the discussion about market tone.
And and that's why I encourage you to subscribe to the newsletter, because we're pretty good at predicting market tone. And we don't just look at the candlestick formations ourselves. We're subscribing to a number of things as well ourselves. I mean, hello, I know there's a lot smarter people out there that do this as well, and I'm trying to gather as much information from a variety of sources. And if I'm trying to determine if what I'm thinking the market's doing is lining up with what other people are thinking the market's doing too. So subscribe to the newsletter. It's free. Let's see. The next thing that I want to talk about is SALE. SALE. Now, I'm going to back out on my daily chart so we can see what's been going on here. It's been in a notable downtrend, and it's been going through these cycles where it's what I call legging down. It'll run sideways for a while, and then bam, leg down. It'll run sideways for a while, and then bam, leg down. And this thing is due to leg down again. Now, the company itself has fired a CEO and hired a new CEO, and within that time frame, nothing has happened. They've also released some new technologies, and nothing happened. It's still moving sideways. We anticipate that based on past performance and based how new actions within the company have not altered that performance, that it's going to leg down again. We were able to get into, did we pay 10 cents for these?
Yes. Yeah,
And they were what, 2 weeks out on the expiration date when we bought them? So we bought a put. We bought the $15 put. We anticipate it's actually going to leg down to $11. But we bought the $15 put for 10 cents. That's what we paid for. And it was 2 weeks to expiration. We bought it. We got to Friday. I said, it hadn't legged down yet. Okay, well, I'm going to do it again. I'm going to throw good money after bad, because I still anticipate that this is going to leg down one more time. I did not buy it. And the reason why I didn't buy it is because by the end of Friday, the little movement that it had made down had altered the price beyond what I was willing to pay for it. So I'm trying to pay between 10 and 15 cents for the next expiration date, which is 10/18, okay, roughly 30 days. I think it's more like 20 days out. But it had moved to between 15 and 25. The spread on the bid and the ask was not in pennies, it was in nickels. And the bid was 15 and the ask was 25. That's too big of a spread for me to try to get into it. So if on Monday or Tuesday it alters and changes and it's still flat, I'm gonna jump back into this for another 10 cents or so, 10 or 15 cents, because I really do anticipate that it's going to pop down again. And this is pure speculation, but it's speculation based off of past performance and speculation based off the fact that all changes that have happened within the company have not altered the current performance of the stock in a positive manner. So it's still a risky play. It's pure speculation, but it's speculation based off of past performance and what's currently going on within the inner workings of the company. Do you have any comments that you want to make on that, Tanner?
Some plays are just worth the risk. I mean, all of them, obviously, when we're getting into positions, we are taking a risk with our money, and we saw that if in fact it does leg down, you can see the leg down back in May. That's a leg down, and then it recovered some of it and moved down even further, and then leg down again August the 4th. So and I know we didn't count the candles, but you can kind of count candles sometimes to determine how long it's going to be before another move down. And the same thing here. It's been going sideways, hasn't been making new highs. In fact, it's been making new lows toward the end in September. So buying a monthly option a month out for a dime or maybe even 15 cents, is that worth the movement from, say, $25 all the way down to $19 in one day? And in my book, that is worth the risk, because if it moves
Yeah.
down the same distance, you're in the money, and you're not only in the money, so you've got intrinsic value. You're in the money a long way.
Yeah, you would have turned something that was worth anywhere from a nickel to 15 cents into something that was probably worth $4 or $5 minimum.
That's right.
So, I'm gonna do it again if in my luck it'll leg down on Monday, and I'm like, dang it. But I'm waiting for it to get into a little bit. I don't want to pay a quarter for it. I'll pay 10 or 15 cents for it. That's my opinion anyway.
Yep.
So I'm going to unmute everybody. There we go. Does anybody have any comment or question on sale about why we paid that? Because it is a speculation play. Greg, I know you got into this and you were talking about selling your position out of it. And one of the things I want to point into this is we're not the only one that's thinking this is going to do this, because after we bought, implied volatility was nearly 400% on the strike price that we bought, and it kept it from losing any time value. The further it went, the higher implied volatility went, and it kept us from losing time value on it. It was kind of interesting to watch it continue to be worth the same as what we paid for it day after day. No comment.
Hey, I didn't buy it. Paul Bridges is the one that was looking to sell.
Paul.
Yeah. But no, I'm not in it right now.
Okay. I'm going to go back, and I'm just going to leave it unmuted. Everybody's kind of quiet. I don't hear dogs barking in the background. That brings us to GDX. And what the heck are we thinking there? Because if you don't have questions in your mind about why we bought what we bought when we bought it, you should have. So we bought GDX on, was it Wednesday or Thursday, brother?
It is Wednesday.
Okay, so we bought somewhere around here. Okay, and we bought the 2450 call. Why the heck did we do that? Well, there was a couple of things. Remember, I told you that particularly Tanner subscribes to a number of other newsletters and sources. We saw indication that other people were buying the 2450 call on GDX. Why are they buying the call when it's in such a down cycle? Well, there's a couple of things that we believe that are going on. We're pretty certain, it can't be 100% certain, but from all the evidence that's out there, people are shorting gold like crazy right now. They're shorting it, which means they're flooding the market with sell orders on something that they don't own, okay, with the intention of driving down the market. Anytime you get a bunch of short selling going on, it's always going to come back. If I was looking at GDX on a minute chart and these were minute candles instead of daily candles, I look at that and go, oh, that's coming back. Somebody's shorting the stock. And that's what we think's going on. Additionally, I read a news article concerning the independence vote in Scotland, what you can expect to come out of a yes vote if Scotland indeed votes to secede from Britain and become their own country. And it addressed monetary concerns, banking and stocks. And one of the things that they said is if Scotland votes yes, all the shorting that has been going on in gold will begin to rally back because they'll be covering those shorts immediately after a yes vote. Well, Scotland was on the fence about whether it was going to go one way or the other. So part of what we did was on speculation. That was the short-term Friday expiration GDX call for 2450 that we bought because we got it for 10 cents, I think. It was pretty cheap, okay? The long-term 1018 expiration we bought for 55 cents, I think is what we purchased that for, correct, Tanner?
Yep. 55
Okay.
cents.
Okay. Now we heard rumors. We see what looks like ancillary evidence that there is some shorting going on. We've read about it in some news stories. And then we actually consult the chart and says, what is the chart saying? So let me back out on the daily chart, and if you've got this pulled out, I want you to do that as well. And the first thing that we notice is that I can find some key support areas. I'm going to go ahead and draw a line on one of them. One of those support areas is about right there. And if you can't see it close, that's the 2291. I just dropped it in there. It's roughly in there. You could see it crosses and gets pretty close to, if not touches, a few of the valleys. Okay, I'm going to draw another one. Another support level tends to be right down in there as well. Okay, and I think I see a third support level about right in there. So those are some key support levels, and I can back out, and I can see that it's found support over the recent history from back in July of 2013. It's found support right in that area. So we're very close to very key support levels. Now that's on the daily chart. You can also back out on the weekly chart, weekly, and you can see again we're at key support levels. I'll back out on the monthly chart, monthly. Again, you can really see on the monthly chart that that's in some very key support areas. And finally, even in the yearly chart, this may be a bit more difficult for people that haven't looked at a yearly chart. GDS hasn't been in existence for decades. It's still at a key support area. We go back to the daily chart. So, based on what the chart was telling us about key support areas, what we've learned through news stories, and what we've learned other people are doing. And there was one other clue. If you go and pull up, now you can't see it now. We pulled up GDX for that 10/18/2450 call, and the volume on that was through the roof. The 23 and the 2450 call were through the roof as far as volume was concerned. Tanner, were you able to go into the CBOE's website and actually get a running total on what that volume was?
I got they do not allow you to go back and see for an entire week, but for the day, just for Friday.
Just Friday?
The 2450 had 10,341 positions bought.
What about the $23 one?
The $23, let's see, make sure I get my expiration correct, 10,306.
That's very high.
And there's only 365 open interests.
It wasn't like that when we first looked. Open interest was open interest was somewhere like 20,000 or something. It was very, very high, and so it's went in the tens of thousands of open interest down into the hundreds. I try to explain to new people when they're coming into the whole stock market. They're like, "Well, I don't understand it," and that's certainly you don't understand it. But what we try to do is condition ourselves to see the ripples. And here's what I mean by that. If I were to put a blindfold on you and bring you out to a pond and sit you down in a lawn chair right next to the water facing the pond. Now, you can't see anything because you got a blindfold on. Then I picked up a big giant cinder block and I dropped it out there in the pond somewhere. And then as soon as I did, I ripped your blindfold off and asked you the following question. Tell me where the cinder block hit. You would be able to say, well, it hit right there. And the reason why you would know it hit right there is because you could see the expanding ripples and use your own powers of deduction to say, well, those are expanding out, so it must have hit right in the middle. Well, in the stock market, we're basically trying to do the same things. We're looking for those big rocks to fall into the pond and give us evidence, make ripples, if you will, to tell us what's going on. We're just conditioning ourselves to see those ripples. And tremendous amount of volume being sold, the fact that it just looks like people are short selling, evidence from various news stories to indicate, yes, that there is some short selling going on, an awful lot of short selling going on. And look, just your own logic. Is there any reason for gold to be on the decline right now? None. The only reason it's falling is because people are selling it. They're driving it low for a reason. They sell it at a high. They flood the market with orders that they don't own. They don't own it. Okay, that causes the price to drop. That's what short selling is. They wait for it to get down to a predetermined level, and that's when they buy it to cover their shorts. Remember, they don't own it when they sell it. So at some point in time, they're going to have to buy it to give it to the people that they sold it to. So if something was valued at $100 and I flooded the market with sell orders, the market maker has to keep dropping the price to find people to buy it. That's why a price drops or increases. If there's people standing in line to buy it, the price goes up. If there's nobody standing in line to buy it, the price goes down so he can cover those sell orders, those people that want to sell it. He's got to drop it. He's got to put it on sale in order to find somebody to buy it. As that keeps happening, the price keeps dropping. When it gets to a certain point, you buy it at that lower value. Now it's worth $90. Was worth $100, and you put an order in to sell something you didn't own. It caused the market to drop down to 90. You buy it at 90, give it to that person that you agreed to sell it to for 100. You made $10. That's what short selling is. There's a whole crap load of short selling that's going on in the gold market. There's no reason for it to be declining the way it is, other than the fact it's being artificially driven down. We believe, based on all the evidence that we've seen, it's being driven down to these key support levels, and very soon it's going to start to rally back because they have to cover those shorts. If you're shorting a stock, you need to do two things. You need to take out the opposite direction a call on that same thing in case it goes against you. Because just because you're short selling doesn't mean it's always going to work. Right? There could be a whole bunch of people standing on the other side waiting to buy it, and you miscalculated. Okay? So you need to take out a call as an insurance policy against your short selling. So if you screw up, you can minimize your losses. Okay? But not only do you want to minimize your losses, you want to put measures in place that is going to ensure that you will make a profit if you're correct. So not only are you making a profit in short selling, but when you start to come back the other direction, you want to make money doing that way too. You want to make money in every way possible. Not only do you want to buy it, see it elevate in price and then sell it again, but you want to buy it low and you want a call position to say, hey, when I get it up there, not only am I going to make money off the stock, the ETF, the gold, whatever, but I'm going to turn around and make money off of the option as well. So we believe, based on all the evidence that we've seen, there is strong indication that we will move back beyond the $25 range very soon, within the next month. And since we could get GDX for 55 cents is what we bought it for, we thought that was a pretty good deal. Now it's moved against us. So what did we do? We cost averaged down. We bought more. And the position that was worth 55 cents when I first bought it 3 days ago was now worth 21 cents when I bought it again Friday. That has averaged my cost down from 55 cents to around 35 cents. That means I can take a profit sooner when it starts to move in my favor, if indeed we're right and it does move in our favor. I'll shut up now, Tanner. I'll let you follow through with that.
I was just going to say, yep. Everything that you said, that is the appearance of it. And I mean, I've taken a look at gold all the way back to the last major correction in the market, and gold has moved down in opposition to the market recently. Well, you know how if you've been doing this for very long, or maybe even not for very long, you know how every year something outperforms the market, one sector outperforms the entirety of the rest of the market. It's looking as if gold is going to be the sector that is going to outperform the rest of the market when the regular market, the S&P 500, finally goes through a correction. And we know that day's coming. We're closer to it now than what we were, of course, a month ago, by a month. And we can keep talking about the correction, but it just looks like gold is setting itself up for a rally when indeed that correction starts.
Of unparalleled proportions.
That's exactly right. That's exactly right. So gold, I mean, it goes down when inflationary pressures are low, and inflation as of right now is very, very low, but we know that it can't stay low forever because that's not what it does. Inflationary concerns will return to the market. We believe that that just through normal price movement, that GDX is going to respond sooner rather than later.
We didn't see any indication that there was high volume of call positions being purchased 3 months out or a year out or 6 months out. It's this next month is where all the volume is sitting.
This next month. And the thing is, and I'm going to go ahead and throw this out there. Do not take, you guys can't take this as advice to do it. I'm just going to tell you what I'm going to do. If in fact I'm wrong on GDX for this month, I'm going to buy it again. In other words, even after expiration, I'm going to turn around and buy it again. I will buy the next month out in anticipation of being right, because when I'm right, the move is going to be well worth the entirety of my cost that I will have incurred by being wrong or being early. So just putting it out there. That's a freebie.
Does anybody have any comments about GDX? Did anybody scratch? I want to know if anybody said, what the heck is he doing when they got the text alert, if you're on the text alert program? No one. Everybody said, oh, I know exactly what's going on. Bunch of liars. All right. Moving on to Flex. That's the symbol FLEX. And we're not too far from being done, guys. Flextronics. All right. So I got the daily chart up. And I want you to pay attention to this uptrend cycle right here. And I want you to pay attention to this little brief spike right here. So this uptrend cycle that started end of May all the way through middle of June. And then I want you to pay attention to this little spike that happened on September the 3rd, so we can discuss what happened there and why we did what we did. So remember I told you that Tanner subscribes to a number of newsletters. Through one of those newsletters, they called the attention to this particular stock. And we found out through that newsletter that Flextronics were on Friday, yesterday, was opening their books to an analyst, a company that analyzes stocks and rates them from a buy, hold, or sell category. And they were considering upgrading Flextronics from a hold to a buy. That's on Friday they began that process. If indeed they do turn around and change their status from a hold to a buy, what happened back at the beginning of or the end of May through the middle of June is going to happen again right through here, because that's exactly what happened. An analyst went to the company, said, we're thinking about upgrading you. Can we see your books? And they said, sure. They opened their books, they looked at them, they upgraded them from a status of hold to buy, and that's what happened. It went from around the $9.50 range all the way up to about the $11.25 range. That's a significant bump. Now, the company that was looking at them at the time, just a small one. It wasn't like Morgan Stanley or one of the big names that we're looking at. It was just a small one. And indeed, the company that's looking at them this time is another small one. They're not a big name like Morgan Stanley. But if they've already been upgraded in the past, remember we look at past performance to try to determine future behavior. It's not always accurate, but it's the only thing we got to go off of. If they've been upgraded once, they'll probably get upgraded again because it's near term. It's recently happened here within the last few months. And an analyst doesn't go to a company and say, we're considering of upgrading your status unless they're pretty sure they know what the outcome's going to already be. So we went and looked at the price of an option. What's a call option worth? Well, we believe it's going to leg up to around $13 or $14 within a short amount of time. What does the $12 call cost? The $12 call cost us 30 cents with a 120 days to expiration contract. How can I not consider that? Okay, so it's out of the money by nearly $2. A buck and change. Sorry, my math's horrible. It's out of the money, a buck and a change, and 120 days to expiration because it's only a $10 or $11 stock was valued at 30 cents. So we bought it. Well, what's going to happen if within 120 days, what if it happened all the way towards January 1, which is the expiration date on the contract? What if it waits to all the way to January before it legs up that way? Will it still be worth anything because time value has eroded out of it? Yes, there's a mathematical formula for that. And if it waits to the very end, that 30-cent contract will elevate in price by about 400%. I have to wait a half a year to get it, but it's going to happen. How long does it take for an analyst to make their decision? I don't know, 3-4 days, roughly a week, before they've got enough information to make their decision if they're going to change the status. So we decided we would go ahead and make that play. Tanner, you want to add to that?
Well, yeah, obviously the sooner it happens, the better it is for the position. But by looking at how options are priced, if you wait until after the announcement, that $12 call play is going to be priced substantially higher. If in fact they do an upgrade on it, it'll be substantially higher just in anticipation of its move up. So the whole point in trading options is to actually be able to do things, put yourself in a position to do things, or be in a position before the news occurs. And so that's what we're attempting to do here. If we're absolutely completely wrong, we risk $30.
Now, I told you also
over long period of time. So yeah, concerning this. So
yes.
Go ahead.
I'm trying to pull out the exact amount of money, so pardon me while I stall for just a second. Well, I can't pull it up. I'm not sure where I read it. This spike that happened on the 3rd, what happened there and why did it do that? Well, the company announced that they were buying back, and I want to say it was it 20 million shares, or was it 20 million shares that they were buying back, or $20 million worth of shares, or $20 billion worth of shares? There was a 20 in it.
I think, well, there was a 20 in it. Now that you said all those numbers, I don't know either.
I can't find it.
They bought back shares, is what they did. So.
Yes, and anytime a company. Go ahead.
I was just going to say that companies, when they're buying back shares, it means that, I mean, why do you buy shares? You buy shares for them to go up in value. When a company buys shares back, the reason why they buy shares back is because they're expecting them to be worth more later.
And I've got the number. It was 20%. They bought back 20% of their shares. That's significant. Now, why did it not continue to climb after that? I don't know. Okay. But when this other company goes to look at their books, they're going to find, they already know that. This is probably one of the leading indicators. They said, well, this other company gave them an increase from a hold to a buy. Maybe we should too, because they just bought back 20% of their shares. So that's going to weigh heavily into the decision. And a company like Tanner said, they don't buy back their shares unless they've got really good reason to do so. And it's all involved with dollar signs. Are they going to make money if they buy back 20% of their shares? Go ahead, Tanner. I'm sorry. I just totally just ran right over you.
Oh, no, that's exactly right. Companies that buy back shares is because they're in a good financial position, number one. Number two is they expect their stock value to go up so that at a later date they can sell those shares back into the market for an increase in capital. So, I mean, ultimately that's what companies do in order to raise capital for, like, new projects or going into a new market, or for example, I heard that Tesla is going to have to sell. You know how we have IPOs, initial public offerings? Well, there is a such thing as a secondary public offering, which Tesla is going to end up having to have a secondary public offering in order to raise money for their giga plant that they're building out in the desert. And so they moved down, they kept down on Friday off of the news that they're going to have to raise $6 billion in a secondary public offering. So, I mean, in order to raise capital, companies can do several things. They can do a secondary public offering, which automatically devalues the shares that are already on the market, or they can turn around and sell shares that the company owns themselves, and they can do that stealthily. They don't have to necessarily announce they're doing it. Or they can do bonds, but right now, who wants to buy bonds? Seriously. The yield is so low on most bonds, and of course, I'm talking about treasuries there, but even still, bonds from companies, they're traded just like everything else, and their yields are relatively low in comparison to what you can make off of selling or buying stock. So just like Tesla is going to have to have a secondary public offering, when a company starts to buy those back, it is almost always a sign of good things to come for the company. So,
all right. Did anybody have any comments, questions, concerned about Flex? Nope.
If Flex hits its 100-day, I'm going to be looking to change my average. Get back in. Well, not back in, but.
Did you buy into Flex?
Oh yeah. I like this. I like the ramp up and then the base sideways. And if it does, if for whatever reason it wants to come back to its 100-day, I'll be looking to buy another one or more of them, because I mean you can see the 100-day pops.
Yeah, if it were to drop down to the $10 range, that's an 85-cent drop. Then yeah, you just cost average down. If you still feel that, you know, what's going to happen is going to happen, and I really do think that that's what's going to happen. But I feel good about it. I wouldn't have done it if I didn't feel good about it.
Yeah.
Tanner, well, speaking of GDX, I said I bought a short term that expired on Friday, and that yielded no result. Did I really discuss why? I don't remember.
Why you bought a short term on the call?
Yeah.
No, you didn't discuss
Okay.
that.
So there was a discussion of a short-term rally in gold because people were going to start immediately covering shorts if Scotland seceded from Britain and became their own country, and the vote was right on a knife edge. So it was a speculation play, because if they would have voted yes, we would have seen really high volatility in gold. We would have seen a spike in gold prices almost instantly Friday morning. And so it was purely a speculation. There was nothing about the chart that tells me that it was going to go up. It was a news play. It was a news play on a chance that it might go up, and I went into it with the assumption that, you know, I might lose it, and based on the current trend, and that's exactly what happened. I lost it. So that's why we did it. That's why I did it. I don't think he did it. He bought the long term. He didn't buy the short term. Last thing that I want to talk about is playing an IPO. So when a company has an initial public offering, most of the time options are not available immediately until later. So Alibaba had an initial public offering yesterday, and there was a lot of excitement over this, and a rabid excitement over it, because Alibaba is a Chinese equivalent to PayPal, Amazon, and a few other type websites all rolled into one. And let's say they have a Chinese equivalent to PayPal. They call it Alipay. They have the Chinese equivalent to Amazon. I don't know what it's called. And then they also have a Chinese equivalent to eBay. All rolled into one thing. And plus they do several other things, and they're very, very, very profitable. Chinese don't do anything. They do so much online, it's not even funny now. They really trounce us in comparison to shopping online. And so they're very profitable, and here they are. They're going to come in and make this big announcement. And they raised $200 billion on Friday with their initial public offering. Now, what goes on with an IPO is additionally, when they say, hey, it's going to be an initial public offering, it's going to happen Friday. Problem is you can't buy it when it actually becomes available. They release it on the floor of the New York Stock Exchange to big boys, these institutional investors and companies that can buy tens of thousands and hundreds of thousands of shares. They get a hold of them first before you can ever buy one. Okay? And so much later in the day on Friday, they finally released it to everybody else. Now, when they initially released it to all those institutional investors, it was valued at $68. What always happens is there's an immediate spike, and there was. It went all the way from $68 to $99 when it was finally released on Friday to you and me several hours later. Well, anybody that bought it at $68, $70, $75, $85, okay, knows what's going to happen next. When they released it at $99 to everybody else and we jump in line to buy, they sell into it, okay? Hey, I bought it at $68. You want to pay $100 for it? I'm going to sell it to you because I know it's going to drop and come back. They sell it, it immediately drops in value, okay? So in buying stock, personally, and I think I speak on behalf of Tanner, we would never want to buy it at the open. We would want to wait until it breezed down, because it's gonna. And indeed, it dropped down all the way to $93, okay, where it stayed and flatlined because they were selling into it at that price. Remember, they paid $68, $70 for it. You're buying it for $93. They're making a killing, okay? And that drives the price of the stock down, and it did. And they're going to turn around. They're going to wait and see if it flatlines there, and they'll buy back in at a cheaper price, okay, and keep all that money profit. Well, is there any way, if you're an options trader, that you can play this? One of the things you can do is to find out if there's similar companies that are tied to them, or if there are other companies that own shares. In this case, Yahoo, a publicly traded company that has options, owns just over 20, I think it's 22% of Alibaba. They own 22% of Alibaba. So let's go look at Yahoo and see if maybe I can get into that. I'll pull up Yahoo on my daily chart. And you can see, hey, what happened? It tanked. It spiked up. It opened at 42.50, close to. It spiked up to over 43, around 43.25. It fell throughout the day all the way to the $39.50 mark, where it rallied back to finish at 40.93. But the bottom line is that's one big old red candle. So if you would have bought on thinking that I'm going to buy in with a frenzy, you would have lost. And it just so happens we have a trader online with us that actually took a chance, okay? It was a pure speculation play. I don't want to make this guy sound like a dunce, because he's not. I know him. He's not stupid. He made a speculation play. He had made several wins with SPY over the last few weeks, so he had some extra money on the side. He decided that he would make a speculation play. So, Mr. Greg.
Oh, yeah.
Go into you did the same thing we said. You looked for another company. You knew Yahoo owned 20%. You jumped on board.
Yep.
And you played this directionally, correct? You played this on a call up.
Yes.
Okay.
Yeah. Looking for it to spike up on Monday. Which one of those candles was Monday this past week?
That was the 15th.
15th, yeah. So somewhere in there, I bought a call for $50 strike price for 14 cents or something like that. And
No,
I wasn't
pause right there. If current value was around $43, if you bought a strike price for $50, it should have been worth a penny. Yet you paid 14 cents for it. And what I noticed, and it's no longer available because all of those numbers have been reset, was implied volatility on Yahoo was nearly 400%.
I like it.
Which means if you did not get out of that position prior to the opening of or the release of Alibaba, which Yahoo owns 20% of, 400% would go all the way back down to the normal levels of around 40 to 45%, and you would have lost money.
Yeah, I checked
And
it.
you knew that going in, right?
Oh yeah. I checked it. It was a straight lotto play. I wasn't expecting it to go to 50, but I was thinking 45ish, and I was thinking just for a quick double, and it was more of just an experience play, and just to kind of see and play the excitement. And when I looked at it Friday morning, the bid and the ask was like 4 to 6 cents. So. Yeah, I mean, and I didn't even look at it all week. I set an alert on my phone, on the app that you guys refers to,
Endorse.
and I think I had it for like 45 is what I want. If that would have alerted me at 45, then I would have looked over it and paid more attention to it. But I was busy with other things, and I just jumped in for the fun of it. And like you were saying, I had some wins for the SPY in the past couple weeks, and I didn't. I had 2 contracts that I threw at it, and I just wasn't. Like I said, I was going in, throwing it as a lotto play, and I just let it roll.
Well, I think what I want to point out to this is because we can learn a lot from what Greg did about what not to do. And we've stated this in one of the videos before. You really want to pay attention to implied volatility. And when you go into these announcements, whether it's an earnings announcement or in this case, or the release of a new IPO to a sister company or a company that another company owns a lot of shares of or a large percentage of, in which case Yahoo does, you have to look at implied volatility because Yahoo had 400%, and as soon as it announced, it went back down to 45. Well, that means any gains that may have been made would have instantly evaporated. You wouldn't have made any money. You probably would have lost money even if it moved in your favor. In this case, it moved against you. I played Netflix once. Tanner was in. He watched me do this. So Netflix is going to announce an earnings, and I pick a direction. I think it's going to go up, and I buy one way out of the money, and I paid. It was like 20 cents. Okay. Now, implied volatility, I can't remember how high it was, but it was over 100%. I want to say I paid over $100 for it. Yeah. And it did indeed move in my favor like $30. So at the announcement, Netflix gaps up $30. I would expect to make money off of that. Because the implied volatility was yanked back out of it instantly, it didn't gradually fall, it instantly evaporated, I actually lost money even though the stock moved $30 in my direction. And I learned a very valuable lesson. Pay attention to implied volatility. Now those are where it can spike up and spike down instantaneously. There is an exception to that. Tanner, explain VXX.
VXX. That's one of my favorites. Implied volatility, well, in particular, when it's rising, when VXX price is rising in value, implied volatility is actually being added to your price. and then when it reaches a high, implied volatility will stay pretty level while it's sitting there, and then as the price drops, the implied volatility will drop as well. So it's harder to make money on put in the short term on VXX than it is to make money on calls in the short term on VXX. Did I explain that well enough?
Yes. But what you want to pay attention to with implied volatility there is it just doesn't instantly evaporate. It erodes over time. There's a time value associated with how fast implied volatility gets removed and it returns to more normal levels. So VXX moves inversely to the market. So if the S&P 500 is soaring to new highs, you can expect VXX to be soaring to new lows. Okay? And if it's moving quickly, implied volatility begins to be added into that. Okay? So when you notice that the market, it's tanking, it's now testing its 50-day. Oh, look, it just went through the 50-day. Now the S&P 500 is heading to the 75 and the 100-day. I'm going to buy VXX. You'll look over there to VXX and you'll find that it's near 80%. And you're like, well, crap, I ain't paying extra for that. They're just going to yank it out of it and not going to make any money. You'd be wrong. So if the market continues to tank, more implied volatility will be added in. You'll increase the amount of money that you make off of it quicker. You can get your double quicker and get out of it sooner. When it levels off at the 100-day or the whatever it's at, and it's considering maybe coming back up, you've got time to actually get out of it. It's not going to instantly evaporate on you. It will hover at those levels and wait for it to start moving the opposite direction before it begins to remove that implied volatility. Does that make sense? VXX is the only exception to implied volatility increases and decreases that I can find. Do you concur?
Yeah, it's the only way that we can play. It's the only ETF available for us to play. If you want to start playing with futures, which I don't recommend yet, then there's other ways of doing that, but futures are a whole lot more complicated than what I really want to get into at the moment. So, but yeah, VXX, you want to play calls on the short term, you want to play puts on the long term. Because VXX tends to have a natural time or a natural value decay is how I would like to say it.
Okay. So
if the
once
overall
again,
stock market's just moving up and down in a really small range, even though VXX kind of moves inverse to the market, it's going to continue, even though the S&P is moving in a small range, it's going to continue to erode in price over time. And I'm talking about the value of the ETF, not the option. Because obviously the option over time, it loses time value.
So when the market is headed down, when we're testing the 50 and the 100-day, you can get into a short-term call with better results. But when the market is recovering and rallying back, you want to look at a longer-term put, because VXX will be falling at that point. But you want to look at a longer term so you can offset the implied volatility being removed, correct?
That's correct.
If you were to pick a short term, you would watch your underlying stock value or ETF value increasing, but yet your profit margin flatlining and staying the same. So buying the longer term where there is no implied volatility ramped up into it is smarter. I won't say there is no implied volatility ramp up or ramp down on the longer term. There's just not near as much.
That's correct. Correct.
Okay. So that covered everything that I had on my notes list. Tanner, do you want to add anything about anything before
I'm just excited about trading. Wishing everybody the best.
Does anybody else have anything that they want to bring up or questions or anything? Typically when I say that, y'all are dead silent. I don't know why, except for Greg, who's an anomaly. Greg will talk to anybody about anything at any time. It's like a preacher with a microphone, man. He'll just go if you give him a chance.
I'm in.
Okay. All right. Then that's all I have. Going once, going twice. Nobody want to raise their hand or say anything at all. Last chance. Going. Thanks, everybody, for attending our conference call. Again, we will have this archived on the website by Monday. So everybody have a great weekend. Peace out. Bye.
Thanks, Jimmy.